Hey, M&A scientists. Quick one before we jump in. Today's episode is brought to you by S&P Global Market Intelligence. It's Q4. That means closing out deals and building pipeline for next year. If you're sourcing new opportunities or pressure testing a target, you need real visibility, especially with private companies where data is usually a black box. S&P's private company data gives you access to comps, market maps, headcount trends, ownership insights, and more across over 58 million companies globally. If you're tired of flying blind, check it out, spglobal.com/PCD-science. That's spglobal.com/PCD-science, or find a link in the show notes. Now let's get into the episode. Hello and welcome to the M&A Science Podcast. We are live at the Buyer-Led M&A Virtual Summit. Buyer-Led M&A is about strategy, alignment, and efficiency, putting value creation at the center of every deal. Today, we're diving deep into one of the most complex and underestimated areas of M&A, carve-out transactions. Joining me is Keith Crawford, Global Head of Corporate Development and M&A at State Street Corporation, trading as STT on the NYSE. Keith brings over 20 years of expertise at State Street, where he's led some of the most intricate custody business carve-outs in the financial services industry. Previously serving as CFO at State Street Global Advisors, Keith is an expert in navigating dependencies, negotiations, and integration challenges that make carve-outs so difficult. Keith, how you doing today?
I'm doing great. How are you?
Hey, thanks for joining me live this time.
Absolutely.
I know last time we did this years ago. It was like a virtual, so hopefully get a little more fun. We're here live in Deal Room headquarters in Boston with a fellow Boston-based company as well.
That's right. It's a great setup here.
Well, I appreciate it. I know you got a bigger, nicer office, but you came to our humble beings over here. Can we kick things off a little bit about your background?
Let's do it. I'm, again, I'm an accountant by trade. Got my letters, CPA letters as getting out of school, passing the exam, and then realized it's a little boring. It's not for me. I wanted to get into M&A. I worked for a publicly traded company, which is private now. It was a company called Gerber Scientific. And they did 2 acquisitions while I was in the internal audit department. And back then, in those days, they used internal audit for special projects as well. So we got put on the scene for M&A, and I got the bug. I said, this is what I want to do. I want to do this all the time. I don't want to just do this sporadically and then do audit on the side. So moved out to Ernst & Young, got my master's in finance. And with Ernst & Young, I did due diligence for private equity players, mostly some strategics, who are on a massive uptick in terms of acquisitions in the late 90s into the 2000s. So I was there during the dot-com boom, which was very interesting, and then moved on to State Street. And State Street is a pretty astute, acquisitive company, for strategic purposes, and here I am.
How many deals have you done?
I'd say over 50.
And specifically for these carve-out type of transactions, how many of those have you worked on?
Probably close to 15, I would say.
Okay, that's quite a few. And I'm curious because you come from a real strong finance background. And when you look at today, when you're overseeing M&A end to end, what are those additional skills like beyond the financial numbers that you had to acquire to really get good at doing M&A?
Yeah, absolutely. So when someone who doesn't really understand M&A, like my kids, they say, what do you do? And it's hard to explain when you give them the technical response. But the way that I've summed it up is, I guess, and it's not totally accurate, but it's the best way to do it. And it's the best synonym for it is I'm a general contractor. I assemble a team of experts, tax, compliance, risk, operations, IT, and the like, and bring them together. And we go in and we look at the underlying business opportunity. And I know enough to be dangerous, but I'm not the expert. So it's sort of like a general contractor would walk in the house and he'd see wires sticking out from the wall and he'd say, uh-oh, need to call an electrician. It's the same thing. I look at it and we're looking at something and the tax situation's a little messed up. I bring in the tax expert and we look at it. And so it's really bringing kind of all the thoughts and ideas and the findings together to try to figure out what, are we at the true valuation? And then what are the issues and the hurdles for us to get the transaction completed? And why we're here today, what is the integration? Can the integration be done in the time frame that the team collectively projects to go forward?
I like that analogy. It's all about the team and making sure you got the best team for the job.
Yeah, absolutely. And no one person on the team can actually determine a large issue that comes up. You need a collective view from everybody because it is interrelated, and that's the key. And that's the key to integration. A lot of things are interrelated, and people need to work together to do it.
When it comes to carve-outs, what are the biggest misconceptions people have about carve-outs?
Yeah, I think the biggest misconception is firms that do it often and do it well, that they can adopt some kind of scalable template to go forward. And I caution on that because no two deals are alike. So what I like to say is that the template is probably 80% accurate from deal to deal, but then the 20% white space in there, which you've got to create your own projections going forward, your own performance in terms of how they're going to execute. I think those are the things that you've got to keep open for that distinct deal because no two companies are alike. They all establish and set themselves up differently, at least in my industry. I know, and we're dealing with banks, and banks are fairly homogeneous in terms of what they do, but at the same time, how they set up their operations internally, that's bespoke, and it differs bank to bank. So that's why you need to make sure that you've got that area where you're going to really focus on and put the team in to analyze that to ensure you're not just relying on, oh, we did this in the past, I've seen this is where it goes. You need to make sure you go down all the way to that detailed service level to understand how that's going to be transferred over.
You can't be fully template reliant.
That's right.
So I want to speak from a little experience. Some folks know, but if you haven't, I recently stepped down as CEO of Dealroom about a month ago, and I'm actually working on carving out M&A Science from Dealroom and standing it up as its own business, which is the absolute opposite size of scale that you've probably worked on, where I'm grabbing maybe 3 employees or so. But I got to tell you, from firsthand experience, it's such a pain in the ass. And the things I didn't expect, first and foremost, was all the vendors. You have to renegotiate with every vendor you're basically doing business with and come up with new terms to stand it up in this new entity. That's one that was a big surprise. And then the other was all these things that you thought you had scoped out for the carve-out, and then you find out that there's these other things that you didn't scope out. So once you pull the rug back, then you find those. And then I think the other thing was the people side, that the ring fencing is the term, but really figuring out who goes with the business, who stays. And when you have people that were split 50-50, it ends up being some pretty tough decisions. But I don't know, it sounds like those may be things that you have experienced.
Those are absolutely, you've highlighted key areas that we focus on in the carve-outs. They're important, particularly third-party contracts. Massively important, because when you've looked at their projections going forward, they're using their historical projections of what either their license fee or service fee is with that third-party provider. It could be a major part of their platform or their service that they're offering. And if you come in and acquire it, most of these, they're smart. They have change of control provisions in there. And so what it requires you to do is to renegotiate.
That's the thing I'm coming across. Like a lot of them are going to want more, they increase the price on you, or they're just not going to give you the same terms that you had with the previous entity.
That's correct. And that's why in our preliminary non-binding bid that we have a long list, a set of assumptions. And one of the assumptions we have is that all third-party contracts are at or near the historical costs or the historical fee levels. Because that's going to impact your underlying valuation if you come in and you're paying 20-25% on a large third-party contract.
So that's going to be in the LOI.
That's right.
That we're hoping to get the same terms of these vendors.
This valuation is based on these set of assumptions, and then if you go in and you do due diligence and you get into the agreements, you do need to eventually, before you actually sign the transaction, probably on a confidential basis, reach out to those significant third-party providers and see if you can get, replicate the actual service and license at the same level or near that level.
What if you get surprised? Some vendor doesn't want to play nice and they want to double the price, and it's significant.
It's happened before. I think you ultimately get there because the vendor doesn't want to be too greedy about it because they're going to continue their service. So if you don't execute the transaction, they're at the same level. And, it may get sold off again, and there may be issues where they'll actually try to do a workaround in the future so that they're not going to prohibit that business from being sold.
So that's good. I'm getting my money's worth on this interview.
Yeah.
So
Yes.
get that up early, put in the LOI. What about the unscoped stuff? As you go through this, and I think part of this lends to the TSAs. I think in this case, they sort of have controlling interests on both sides. But, how do you navigate the TSA component? Because there's things that you'll know about, but then all these things that pop up that you didn't know about. Like, how do you sort of keep face where it's not a bickering?
Absolutely. So that is something, I think that's where the devil in the details comes out in terms of where you can really run into trouble. If you haven't had a full scope of what the perimeter is, and that's difficult, and it progresses through the deal. No one seller is going to have the full perimeter figured out. They just don't understand what the buyer has and doesn't have. So it's definitely an iterative process between the buyer and seller to figure out, okay, I need these services, I need these supports. Particularly if you're going into another country, we have capabilities, but sometimes we don't have capabilities that abide by the local requirements or the local country requirements and laws and regulations. So they're assuming that, you've got your global, you have your own platform, but there are nuances that happen, particularly with some certain services that we can't replicate because we just don't have that level of requirements in that particular country to work through. So those are things that can pop up that you have to be careful on. And you got to write a TSA on that for sure to make sure that you have continuity going forward. And then the question is do you either lift that out? Do they turn around and license that to you and you use that in the future? That's not ideal because then you're dependent on the seller. The seller doesn't like that either because they'd like a clean break. So I think those are things that you have to think about. Or is there another player in the market that provides that service that you could eventually migrate that to?
Sounds like no matter what, you can't get around it. There's going to be these unknowns that you're going to have to work out. I'm curious. I'm fortunate this is like a pretty closely held deal I'm working on. But if it wasn't, and sometimes you deal with difficult sellers, I'm sure you have.
Yes.
Out of the 15 deals.
Yes.
What do you do? Like, is there a point where you're like, this isn't? Well,
you try to be as transparent as possible in terms of what the need is. It's not a deal tactic or a deal negotiation position. It's something that's inherent. So look, a couple of years ago, we looked at a company internationally, a bank as well. It was a carve-out. And as you said, when we were going through it and we were going every level of service in the actual core due diligence, we realized there were some services that were being provided by the outside of the perimeter of what we were acquiring. And that involved people in an organization in the bank that serviced different parts of the bank that weren't part of the perimeter. And we said to them, well, we need some of those people to continue the continuity of the service. And they said, well, you have that. And we don't. We don't have that. We're a narrow type bank compared to a universal consumer bank. And that's something we'd either have to hire the people on or bring the expertise over. And we debated about the cost of it. It ended up being material enough that we thought that the transaction should require an adjustment. And we ultimately didn't get there as a result of that. They thought it was an immaterial component, but at the end, we thought it was material. So we walked away.
That goes back to the people side, the ring fencing and making sure that stuff's allocated. And you saw clearly a gap. And
that's correct. And then, it's hard to know even when you're signing because you can't get down to the detailed level of service because the confidentiality reasons. You've got a small group of people on the sell side that are selling their business. You're worried about this leaking to the market. So you're even doing work post-signing between signing and closing that you'll find issues on. So you try to build a reserve in there for that as well, because you're not letting everybody know in that business, depending on the size, and in most instances, most deals that we look at, you're not letting them know that they're being acquired while you're negotiating it. So there's certain components and details that even, the smartest people at the top of the house in the bank that are selling this asset, they don't know the underlying services that are being provided either. So that's something you've got to work together, as I said before, an iterative process between the two parties to try to make sure that they've really nailed down exactly what the perimeter is.
Wow. Is it because you're public, there's like exponentially more sensitivity for deals getting leaked versus private to private?
Yeah, I think so. Private, I don't think it really impacts anything, but you would be worried from a private firm as well. I think because you don't want other players coming in and coming over the top. But yes, from a public perspective, absolutely. It's material non-public information, and that should never be disclosed.
So if it's private, it's more concern about a competitive bids coming in and also maybe employee perception, if that creates some negative sentiments.
Yeah.
And then you're public, you got a stock ticker.
That's right. You've got stock and you've got, SEC laws that are out there as they should be. And then the other thing I would say is you want to keep, I would say most employees, if they hear that they're being sold, it's not a comforting thing to them if they don't have the details.
Right.
So when it leaks, it causes a lot of chaos in the organization.
You want to control that. How do you build strategic alignment upfront to avoid M&A, on impulse when you're doing these deals?
Yeah. So I think, the deal team is fairly specialized, has a great degree of expertise. But what also needs to happen is you need to include in the deal team those individuals that maybe don't know so much about deal tactics, valuation, and the like, but know the underlying business cold. And you have to bring them in, not too many. You have to have the right balance. You can't overburden the team, and they have day jobs too. They're doing other things that they work on. But you bring them in and you augment the team with that expertise, and their focus is, as you're going through the diligence process, they're thinking about the integration and the day one and the BAU opportunity, and they're giving us feedback in terms of, hey, it's an easy one, or hey, this is going to be difficult, or we have difficulty in these types of areas and we got to focus ahead. So that does direct some of the diligence that happens at that point, which is a good thing. And then you have the continuity of those individuals, because your intent and the hope is those individuals will actually be key individual members of the actual integration team, where hopefully they're spending full time until the integration's complete, or a considerable amount of their time.
So you're bringing people for the business. They're thinking about how's this actually going to come together, how they're going to integrate it. But because of that, they're going to be able to impact diligence in a lot of ways, knowing that what they're trying to achieve. What about the deal model? Like, is that also, because when you look at the deal team, it's fun to come up with assumptions on synergies and model it out.
Yeah, you're hitting on where I was going to go next. It's the synergies, right? The synergies are critical, and the synergies don't happen before the closing. So that's why integration is critical. So the integration team needs to know clearly what the synergies are and when they need to be achieved, because that's the operational or the migration or the integration aspect that needs to be mapped out from a timeline perspective so that the deal model actually comes true.
So I've been doing more part of like M&A science Carve-Out, like lecturing more about M&A and what the life cycle looks like. But I find it difficult to explain how M&A, it's beyond the timeline, because you always think of like, hey, you sign a LOI, you go through confirmatory diligence, you get to purchase agreement. But what you described is the key thing that doesn't show visually. It's more of this correlation of here's diligence, here's integration planning, and your deal model. And one discovery affects the other, where you might come up with something, or here's something that we didn't think of an integration plan that warrants us to do more diligence in a specific area that has us go back and change one of those synergy assumptions.
That's absolutely right. And I think way back in my career, I think it was bifurcated. I think the deal team went and executed the the actual transaction. And then when they knew the transaction was going to happen or right when it signed, hey, let's set up an integration team. And then you had to do that data flow information sharing, which takes time. And it's inaccurate because you're actually feeding your observations or your findings to the integration partners, and they're not seeing it firsthand for themselves. So I think that's what's happened over time to create it, and why we've been so successful is integrating that sort of, no pun intended, integration team into the deal team at the right level, at the right balance, to make sure that the handoff is seamless. And it's not, and nobody's surprised by, well, we were going to do this by when, or those synergies they're quite high.
So handoff, there's a sort of alignment on timelines, and then also alignment on synergies that this is realistic and achievable. I like this. This is where you're describing buyer-led M&A.
Yep.
This is that approach to really focus on success of the deal with early thinking and integration.
Yeah, and we do a post, the day one, we do a day one sort of 100-day plan going forward, and there's goals and highlights and achievements and milestones that we build into that plan. And then we meet pretty frequently to ensure that we're going there, and we do post-deal analysis as well in terms of maybe a year out, we go back, or 18 months out, we go back, we look at the deal model and we look at the actual results and we say, did we achieve, or did we not achieve, or did we overachieve?
Do you have an example of bringing this model with the integration team in, how they've impacted deal terms?
Yeah, they have. I would say it's really in terms of the duration. They probably impact the deal terms in every way, but I would say more commonly in the transition services agreement. And that is, you've got the deal team who has some degree of knowledge, but they actually aren't the ones that are going to go through and perform the migration or the integration. And so you have to have that integration team there to really realistically set the deadlines, because we're sometimes, we think in terms of quarters or multiple quarters. And if it is a comprehensive process, for whatever reason it might be, jurisdictional, regulatory, they will tell us, you can't do this in 6 months. This takes 8 months, takes 12 months. And sometimes it is in terms of reporting periods because of what we do. Quarters matter, investment portfolios matter, and the like. So you just can't do it. A lot of our conversions actually have to happen over a weekend, and you need to be able to do it in a big bang. So that is critical in terms of when you can actually manage the TSA, what's the duration of the TSA, and then sellers typically want you to get out of there quickly. And so and we want to be out of there quickly as well, but it doesn't always happen that way. And that's where I think it's critical from having those expert integration people on the team.
So they prevent headaches and surprises. Do they ever push back on your synergy assumptions?
Always. So there's
something we don't want to talk about. Is that
it's a constant, it's a healthy debate. It is. I think if you leave it to their own discretion, they're going to pad it. And I think by nature, being the financial and representing the financial side of State Street, they're going to want those synergies to show up sooner rather than later. So there's that healthy exercise, and it does get heated at times. And then we look at, we have enough deal comps in our industry, in our space, to understand what past transactions, not even just State Street transactions, but what past transactions have actually realized in terms of cost synergies and revenue synergies. So while they're guideposts, there are reasons, as I said previously, all companies are created differently. You may not realize them, to the norm of what the industry is, but if you're not close to the industry standards, then you've got to explain why.
Well, it's admirable. It's a voice you actually listen to, because there's a lot of organizations I know, they absolutely have no voice anywhere near the table. And, you just sort of build a model to get the deal done.
Yeah, and what I would say is most synergies are critical for what we do. I would say, just because of the space that we're in and the different businesses that we're in at State Street, we're not able to go out and buy something X synergies. Synergies are required there to substantiate the deal and substantiate with the return of the deal. So it's always critical in terms of us realizing that and being able to scale our business or being able to expand our revenue profile in different countries or with different clients or different services.
Can we talk about sourcing deals?
Sure.
I'm curious about how do you approach proactively sourcing carve-out opportunities rather than waiting for a banker book to hit your inbox?
Yeah, absolutely. And because we're a unique trust bank, there's not a lot of trust banks around the world. There are a handful of them. And we're very bespoke in terms of what we provide our services. We're not as wide and diversified as, the other GSIPI type banks out there like JP Morgan. We're more like, the trust banks are State Street, Bank of New York, and Northern. Those are the three largest trust banks. But there are universal banks around the world that actually still do custody and administration and accounting on their own, and they haven't outsourced it or sold it. And so they're a handful. I'd say a little more than a handful, and we know them. We visit them when we go into their jurisdiction or the geography. We're there with them, and we're trying to tell them that your service would be better. It would reduce your costs, and your service enhancement would be better if you actually decided to carve that business out and sell it to us. And I would say there's a lot of interest in those discussions, but even though carve-outs are hard for buyers, they're just as hard for sellers as well, because they need to augment and change their business. And that's not an easy thing to do. And sometimes they adhere to the status quo before they actually say, this is a good idea because this is a non-core capability or business that we provide. And it's a bit of a back and forth and a dialogue that we've had with banks over the years.
Can you explain like custody business to me?
Sure. So basically we consider to be a kind of we're an institutional bank player. You can't go on the street and find an ATM, and we're a bank, we're a charter bank, but you can't go on the street and find an ATM and take money out of State Street. So we don't essentially touch retail. We don't touch retail players. You can't open a bank account with State Street unless you're an institution or, a sovereign wealth fund. So we move money behind the scenes. So when, a sovereign wealth fund wants to manage their fund and execute trades, we facilitate the trades for them. We facilitate the reporting. We facilitate the investment and the evaluation, which is the administration and the accounting as well. And we custody the assets through our global network that we have around the world. So if they're trading Japanese equities and they're in Germany, we can handle it with the infrastructure that we have built.
You move the big bucks.
We touch a lot of money, as does Bank of New York every day.
So this is a business that you really focus on. And when you look at as a strategy for your carve out that you identified, is that there's these other banks that it's essentially their side business. And then that's where you have this thesis that, and you've been operating on this for a while, because you sound like you've done a number of these deals.
Yeah, and that's it. And the biggest kind of impetus for the firms to actually consider carving out their businesses, we're very technology reliant, as you could imagine, moving that much money and custodying assets and performing administration and accounting on portfolios and accounts. We actually require a lot of regulatory requirements that happen in terms of jurisdictionally. So as we all know, the regulatory environment, it doesn't sit still. It's constantly moving. It's constantly changing. And if you have new regulatory requirements for your underlying portfolios, your clients, or whatever it might be, that requires a change to your technology. You have to upgrade your technology or augment the technology so that it can actually provide the service at the standards in which the regulators require. And so that's kind of a big sell point for us to say, yeah, you may be doing okay right now, but you constantly have to upgrade this non-core part of your system to meet the regulatory requirements, and you don't really have the critical mass.
Were you part of shaping the strategy, or is this something that was already existent when you joined State Street?
Well, I think it was there. It was implied. I wouldn't say I was an architect of it, but with the key executives in the custody security services business that we operate, we constantly work together and coordinate with each other in terms of what's the angle, how do we help other firms, how do we help other customers. And a lot of it comes from word of mouth as well. Like certain clients find out that, we're providing certain capabilities to somebody that they know, and we get a referral in. But we're fairly, I'd say we're fairly versed in terms of what the opportunities are on a global level. And we try to focus on areas that we think we can execute on at a high level and a high scale.
That's what I'm trying to get to is like step one is having a clearly defined strategy. What I'm getting is you're not knocking on doors saying, hey, you got anything to carve out? It doesn't work that way. Or does it?
We do. We knock on doors. I did in a
But can you knock on doors and just ask like, hey, you guys got anything for sale or you're looking to carve out? Or do you kind of...
Well, we know their business ahead of time, right? We're
so
not
you
just
have a
saying if it's any for
thesis,
sale.
you have it, and that's what I'm getting is you have the strategy that you've shaped, which is essentially why us, that, hey, we've already got expertise in this. We're able to make the regulatory overhead a lot more efficient, just overall efficiency in operating the business and sort of, and the benefits for them, I guess, selling the business as well.
That's absolutely right. Yeah. And we, like I said, we understand what they're performing in-house. And because they're, in most instances, not all, but in most instances, they're large universal banks. Universal banks have a ton of divisions, ton of services, ton of products, capabilities. We just believe that we can do it more efficient and scalable for them. And that's something that we can take off their hands. It's not really front facing. They're not touching the institutional clients. And if it's a service that they can outsource and have a steady rate and a high level of service, that's something that they're interested in.
Do you think that's a must-have to have an angle that you approach these firms versus just knocking on doors saying, hey, I'm looking for businesses you want to carve out?
Yeah, no, we have to be very, very concise. Otherwise, I just don't think we'll get there. And even when we are concise, it does take time. As I said earlier, carving out a business is not an easy thing for a seller to do. It's a lot of work. And I don't know if anybody, even selling a business in your portfolio is a lot of work, even if it's on its own and it's segregated. So buying is actually, I think buying is less comprehensive than selling. Because selling, you have to know every single little thing that you're actually gonna, and you get there with the buyer, with the buyer, but it is an extensive process.
And especially to get them to want to do this without running a process, or it's sort of on you proactively engaging them to want to do this deal.
That's right.
Okay, so step one, strategy, get the angle down. What's step two?
Yeah, so step two would be in terms of what's the initial price range, valuation range, right? You got to get them interested. What can we do? How can we help you, right? So you have the strategy. It could be worth this, right?
Do we got to talk to, identify the right banks and the right people to talk to?
Yeah, I think, but through our conversations with my conversations with the business leaders and the network that we have globally, in most instances, even when I said this in a prior discussion, but when I was the CFO at the asset management group, which is now called State Street Investment Management, used to be SSGA. Anywhere I went in the world in terms of meeting with my teams, I could call up a competing asset manager and say, "Hey, do you want to meet? Do you want to have coffee? Do you want lunch?" It was an easy thing, and I did it. I did it a lot, and the team does it a lot as well in terms of, we're in the top 5 in terms of assets under management globally. And it's just a big ticket, and those are doors, and you need to be outwardly looking. And, I would say 85% of the conversations probably don't continue, but then there's that 15 in there. And I wouldn't say the 15 are successful, because we all know M&A is hard to do, but those are 15 that are in that area of sourcing of, okay, they're interesting. Is it the right time? Is this where we want to be? How high is it on our priority scale?
If people don't talk about this with proactive deal sourcing, you got to work your butt off. There's no shortcuts to it.
You do, but I would say, fortunately for us, we're narrow in terms of what we do. So asset management and investment services, we're now moving into wealth. Someone like, I'd say JP Morgan, who's corporate advisory, there's a lot of businesses in there for them to figure out, okay, how am I going to make this grow? So we're very, I wouldn't say narrow, but we're very concentrated in terms of where we play. So it's easier from that perspective. But we did enter the fintech world with the CRD transaction. That is the Wild West. That's not an easy market to get your arms around and understand who all the players are. Because as we all know, and I maybe don't know, but in fintech, what I find is most of the firms that were created were all created for sort of one reason, and then they developed thereafter. So any fintech firm that you look at, they're not in categories. They're not homogeneous. They might do the same thing, but then they started or they developed into something different. So it's a really, I think it's a really fragmented space, and it's just one that you really got to spend a lot of time on to understand where the opportunities are.
So benefits of having that clearly defined angle strategy, so that way it's easier to see what targets fit. And then it sounds like the big step is just having the conversations. It helps to have a big company logo. Otherwise,
it definitely helps.
Do more work to get those,
a global company. That's a plus.
Is there certain titles that you want to talk to really make a deal actionable?
Absolutely. When particularly in the custody space, what you want to do is you want to speak to the individual who's not in charge. They're in charge of the custody business or the security services business, but they're not in the business. So if you go to the head of the security services business, it's like we always say, it's like inviting the turkey to Christmas. You don't want to go and talk to the head of the business and say, "Hey, we want to buy you." Their first reaction is I'm running this division, or I'm running this part of the company. I'm being successful. If I get bought out, there's a chance I won't have my job, which in most instances is not the case, because we acquire talent along with it. We're not all about just eliminating headcount. That's not the point. It's about scaling. And if you look through our organization, it's some of the people in the senior management level and the executive level were part of past acquisitions. So we bring in quality talent as well as part of it, but you can't initiate the conversation with that individual day one. So you have to go to above the head of the security services business and put that idea, that thought in, and why they should do it. So that's the target point.
Okay, so let's say I'm taking this as free advice and coaching from you. I'm going to go do a carve-out, and for me, it would make total sense to look at these large companies that have some kind of data room business. So I know like S&P Global, Thomson Reuters, they have these sort of legacy data rooms that are underperforming. Where you're telling me is I don't want to go to that directly to the business unit leader, because of that.
I don't think that's a good start.
And I'm probably looking and tell you I tried this, and actually it was like they didn't want to have the conversation.
Yeah.
So I would go above them. How do you find? Because I feel like it's just so blurry in these large organizations.
It is, and like I said, all companies are different. That's where I tap into the investment banking knowledge. So I have a very wide and extensive network of financial advisors, investment banks, the large bracket banks, all the way down to the tier 3 banks, however you want to evaluate them. And I do find, depending on what level that you're going on, the large banks sometimes don't have the contacts that the next tier down has, because the next tier down they really have to go out there and beat the street for their transactions. Whereas the large ones, they're going to be on one side of the transaction or another if it's a sizable transaction, and they don't have as much networking and contacts into these kind of carve-out type opportunities, which is why we utilize some of the mid-tier investment banks, because they actually know the individuals almost personally in a lot of cases.
So you could engage. So it's good to have the network of bankers, and you can say, "Hey, Bob at Greenhill or whoever, I'm interested in this company. I know this got this business. Can you help me?" Sort of, and they might know something already. They might know who to talk to. And then when you bring them in, are they engaging with you as buy-side representation then?
They aren't necessarily, depending. So look, I mean, bankers are critical. They all need to be on transactions, and they need to be on successful transactions. But I do, look, I mean, we're open. We're agnostic to the bankers out there. And my position throughout my career is if you bring a transaction exclusively to State Street and we execute on it, you will be on that transaction. And I've held firm on that, and that's been consistent. I haven't breached that in my career. But it's really just an introduction to get it at first, and the bankers are more than happy to do it. It's light work for them at that point in time, and it might be a referral back to them if we actually do go with the transaction.
I mean, in some cases, they could help you make the deal actionable if they already.
Yeah, absolutely, and it's about, in a lot of cases, I would say they end up on the other side.
Right. So in this example, you're still buyer led, you're still proactively sourcing, you're still doing this, but they're still using this extended network with the bankers and playing nice and working with them.
That's
that
right.
If they can get the leverage and increase the opportunity of making the deal actionable, it's still a win for you.
That's right. Yeah.
Okay, so we get the combos, we get to the, an opportunity where, hey, there's something potential here. I like your story. I like the why us and why this business case makes sense to do this carve out. Where do you go from there?
It's you sign an NDA. They assimilate their information for the preliminary bid. They give us the core financials of the business. In some instances, we require to do to go hire one of the big four or another accounting firm to actually do a quality of earnings analysis, which actually takes the carve out, and the accountants go in there and they go through every part of the business that they know of, and they try to build a perimeter carve-out P&L and balance sheet, and that's utilized for the preliminary information of which we put our preliminary bid on.
So you got an NDA signed, and then you have a preliminary request list that you'll ask for information, but you'll also do this buy-side Q of E before putting an LOI.
It'll be a sell-side Q of E. So if they really want to carve it out, we recommend to them that they do
so
a Q of E.
you tell them to do it. Okay.
Yeah.
Which is pretty common practice if they're going to even go bank.
It is if they've decided they want to sell the business. If they don't want to sell the business or they're still on the fence about it, sometimes they won't, and they'll give you preliminary information.
That's interesting. So if they are pretty inclined, like they're motivated to do it, they'll do it. If not, they just give you preliminary information. What's your sense between the two if they do a QV versus they don't?
Oh, if they do a Q of E, it's within the ballpark of accuracy. If they don't, it could be wrong. It could be grossly wrong when you get in and you do due diligence, and then, if you self-insure the deal, you do a quality of earnings on self-insurance that the underwriters require you to do that. You go in there and you find out there's mistakes, or there's costs that they didn't include, or there's revenue that's overstated. So that tends to happen. We'll do it quickly and swiftly, but our level of risk assessment is much higher for those types of transactions than a Q of E.
So it's more likely to get surprises where you end up having to go back and renegotiate.
That's been my experience.
This is a great walkthrough on how to source deals. Let's talk about your approach around mapping out the dependencies, creating a unified process across your teams when you actually go and do diligence on this company.
Yeah, absolutely. So, we've been a successful acquirer over the years, and acquisitions for us it's not a strategy, it's to enhance our strategy. So we're pretty astute about that. We do think creatively in how we go through this, but when we do get into the M&A, environment, we effectively, we have a core team. Again, it's built off the historical success of what we do and what we want to augment over time, and how prior transactions have been successful or not successful. And we try to augment it, but like I said, we bring in a core team, and we're pretty detailed up front in terms of the areas of focus and risk to start. Now, again, 20% of that is whiteboard again.
I was going to say, how do you deal with the...
Yeah, so if we're looking at a transaction in another country, we've got to talk about, country risk. Is there currency risk? Is there net interest income risk? Because the interest rates are either tremendously lower than where we are at the home office, or they're higher. These are the types of things that we try to identify up that's driving that initial valuation model. And that's where we tend to focus the teams in terms of getting in there early on in the process to really confirm those points. So the material assumptions are where we focus initially in diligence.
But when you go on, like my example of my tiny little carve out I'm doing, there's all these little things that keep popping up that drive me crazy. How do you sort of keep the smooth cadence going?
You've got to be agile. It's never going to stop. You're never going to encapsulate a transaction up front and have it be consistent with no surprises all the way up to the signing, and even some instances the closing, which you don't want. But you have to be ready. You have to be on. There's always last minute things that happen, and there's always last minute surprises. And that's why the deal team needs to be present, available around the clock, because these do come up in very tight timeline frames in terms of where you're going to print or you're actually going to sign on a transaction, and you find these things out. So you've got to have the team ready to triage right away and try to resolve that to get to that next phase.
Is there any tactics or approaches to smooth that over? Because
well, I mean, I think it's about knowledge and really being inquisitive and intuitive while you're going through it. I think it doesn't avoid all of it, but if you think that the agreements are there, we're settled, everything's working out, there is handoff things that are required. Even just wire transferring money is a big deal in terms of between the signing and the closing. If it's got to go to different accounts, different jurisdictions. That stuff does take time. You got to do preparation. You just can't take that and think it's going to happen within a matter of hours. You've got to spend the time to prep for it. So it's being thorough for everything that's required for signing conditions or even closing conditions.
Get in early, be very inquisitive so you can try to get and I feel like some of these are just reps you do over time. Just, what the key things that you don't want to get surprised with.
Yeah. And constant check-in. If you don't hear something, check in anyway.
Is there like a cadence you found that works really well? I mean, I'm doing like a weekly right now, but is that the right amount? Should it be more or less?
No, I think it depends on the type of transaction that you're on, and the complexity of the transaction. And so if it's a complex, I would say two times a week, the team should get together. And in many cases, you're canceling the meeting. When we're trying to get to a signing, sometimes on transactions, we actually have a nightly meeting at the end of the day. Hey, dude, what are we still on track? What's popped up? Are there any changes? And in many cases there are. Oh, well, we got some more information on this. We've got to deal with this. And then that's when you triage the team to get together. So yeah, I would say it's better to overschedule and overschedule meetings and call them if there's not anything there. It's a good check-in, and it forces people to be transparent, because I think a lot of times when you're not connected or people aren't showing up, things can happen. And look, we're a global company, so you've got to be connected. We're not all sitting in the same floor, in the same room, or in the same office. It's a lot of times it's multi-offices and it's multi-jurisdictional.
Yeah, I'm sure people are happier with canceled meetings than surprise meetings that show up on the calendar. Exactly. So I like that. I think that might be a good thing I'm going to take in, is just increase the cadence and then play it by ear if we need them. And like you said, there's parts of the deal that you're just going to need to do a high frequency of check-ins. Going back to that example with the international bank, what are some of the things that we can talk through that went wrong and how may have changed your buyer-led approach?
Yeah. So I think there's a lot of components that are that need to be finalized. So one of the international banks, there was a component, as I think I mentioned, we couldn't cover. We needed to actually create it greenfield, or they needed to transfer over that capability. There's another, we went in the security services business. When we go to a lot of these banks, they have their own asset management group, and their asset management group, they're doing the security services, the custody, the fund administration, the fund accounting for their own in-house asset manager. It's segregated for regulatory purposes. However, when they spin it out, you've got to create a commercial contract between our business and that asset manager. So that's one of the clients that's going to come along. And in many instances, the clients are up to 50% of the revenue. They could be more, but up to 50%. And the critical aspect of that is, what are the terms going forward? So when we talked earlier about third-party contracts and making sure that they're not going to increase the fee 25 to 50%, it's the same thing that we have to do on the captive. I think the captive asset manager, of course, they're realizing they're entering into an agreement with a third party now, and now they're thinking, okay, we're going to reduce our fees. And then you've got the top of the house within the bank that's saying, no, we want the highest price possible. So we're going to sell this contract going forward. And when you talk to asset managers, they're fiduciaries. So a lot of times they will fight their own parent company in terms of where they think fees should provide. And that's a very delicate situation that you have to deal with when you have a large captive client.
So, and then how did you change your approach overall? Did you just...
So yeah, I mean, we asked the seller early on in the process that we'd like to meet the asset management team, who's ever deciding this going forward. We want them integrated. There have been instances in my past where transactions have terminated because they didn't want to bring the asset management team. They promised that the fees that we were going to get would be the fees, and they ended up not being the fees because the asset manager rebelled.
Oh, wow. Yeah. So
yeah,
goes back to that theme of just early and being inquisitive.
Yeah, and I'll never forget at one point, I think it was back in maybe 2000, and I'm dating myself, but 2005, I had a good friend. He was a banker. He's a good friend of mine still, but he was working on the transaction with us, and he called me. I was sitting at dinner, before I was going back to my hotel, and he said, "We have a problem." And I said, "What's the problem?" And he said, "We just lost $25 million of EBITDA." And I said, "Why?" And he said, "The asset manager repriced. They came in the fees they want." It's a material change to, $25 million of EBITDA at maybe 8 to 12 times.
Wow.
Yeah.
That kills the deal.
Yeah.
How does you make these deals successful? It's all hinges around this integration. You give me really good examples of the stuff you absolutely want to avoid post close. What's your planning process look like to create your 100-day integration plan?
Yeah, and so on the large transactions, we do seek third-party outside help. So we'll go to the consultants out there who have program management expertise and capability, and we bring them in actually earlier, like probably just prior to signing. We'll bring them in and we'll engage with them, and from between signing and closing, we build in a fairly rigorous plan. And as we said before, that's when the meeting cadence gets set up, and that's where we work through a lot of the issues to ensure that synergies arrive on time, the closing. And you mentioned employees earlier before. And the other thing that's key is day one. You want the employees to feel like now they're part of our company, State Street. And so that's a lot of planning that has to happen with the HR folks and with the operations and IT folks, because you want them to have segregated. It's required. They need to have their own email with State Street at the end of it, and they need to be in a secure space. And so that's a lot of planning that has to happen when you're doing a carve-out, because a lot of times the seller doesn't want you in their facilities, so you got to find new facilities. But you don't want to move the employees too far away, because that disrupts their work life and their work-life balance. So that's some of the critical stuff that I think you really need to think about, that I think some people don't think is that big of an issue, and it does become an issue for sure.
So I think early on doing some of these deals, it makes sense to lean in on some consultants to help out.
Absolutely.
The other big thing, I always think of integration, biggest risk is the people. Things go bad, people walk away, and culture alignment, I think, is a big part of it. If you nail it, people stay motivated and happy. If not, they're terrified and they run away.
Yeah.
How do you make that work? Like, how do you, is there any
There's a lot of
there?
thought that goes into that, I would say, dating back all the way to CRD, when we bought Charles River. They were fairly, very successful software business that, they took very great, they were very proud in terms of what they did, but they were very creative. And that's not so much, equivalent to what a banking structure is. So we took steps throughout that integration to make sure that we didn't destroy the culture there and the creativity. And it was unique. It was different. They did things, they kept their old email. We didn't immediately transfer them to State Street. We want them to feel like they were a division of State Street, but they still had that identity, and they still do to this day. So it's been one of these things where I think you've got to think about how you preserve the culture and you preserve the morale in terms of where the employees want to be so that they're continuing to be successful when we own it, just as well as they were prior to owning it. So that, and then also retention. You want retention of employees, and that's critical. And that's a big part of the due diligence process as well, all the way to the integration, is making sure that you're incentivizing and ensuring that those critical employees are going to be there, not just day one when you close the transaction, but beyond that.
So in this example, you acknowledged the cultural differences and actually modified your integration plan with that North Star goal of having a high retention.
That's correct. And we maintain their facility and their facilities outside of Boston. It's probably a little bit more integrated today, but that facility's still there. And when you go there, the brand name's there, it's still there. And I think we've maintained the culture and the success of the business.
I want to take in some audience questions.
First question, how do you influence leadership if they want to enter a market in a new country, but don't want to put the cash in to stand up solutions like payroll, benefits, etc. that can scale and are the most efficient from the beginning?
Yeah, that's a good question. I had experience with that way back. I was stationed in London under State Street for 6 years, from 2005 to 2012, and I worked with the head of Europe at the time. There were 6 countries that we were trying. We were in, but they weren't all equal. Italy being one of them that we wanted to develop more, and so. We ended up doing a large transaction there. We bought Intesa Sanpaolo back in 2010, and it's purely Italian with a small Luxembourg presence. And the issue was, it was far out of Boston. So trying to tell the CEO, hey, we're going to do a large transaction in Italy, and he's saying, well, why would we do that? We had to work hard. We had to work hard with the head of Europe and the team. Italy has one of the top savings rates in all of Europe, believe it or not. I think they are the highest savers personally from a retail perspective. And it's a huge fund market. And so that's where we play. So those were the aspects that we had to put out there and put the projections out to convince where we would be. And it's a fairly profitable market as well, which made people skeptical. But it's just, it's something that you need to work through. So I think you need to drive the assumptions and the drivers and do your work, do your homework, and show the pro forma of what could be and what the return would be. It's really one of those traditional things, but it takes time and it takes resiliency to constantly be, testing it, affirming it, and having the right people have the discussion.
This is from Raul. Hi, Keith. In your experience, what's a common blind spot beginners have when analyzing M&A deals, and how can one develop the right judgment to avoid it?
Yeah, the thing that comes to mind to me is the projections, the growth of the revenue. I do, and probably secondary synergies. I think you really have to drive some reality and some pressure on that. And then your analysis definitively needs a downside case, so people aren't surprised if it doesn't pan out. So I think that, to me, that's what drives the deal. That's what drives the return. If you miss that's a bad thing to miss on. Now if there are unpredictable events like market crashes and the things like that, those are hard to predict as well. But you should sensitize it, and you should make sure that you're not paying a top price without any room for margin or error or any shortcomings, because I think that's putting yourself in a bad spot.
Can I handle the numbers?
Awesome. The next question is from Sean. Given pressure from your own company to close deals in any given year, what tactics do you utilize to keep deals moving and closing with respect to the sell side, especially if you need to close 50 to 60 deals per year?
Yeah. That's a lot.
That's a big roll-up right there.
That's a lot of deals. Look, I think I always say it. You set false deadlines in M&A. They're aspirational. And
do you do time bomb offers?
Sorry,
Time bomb offers?
No.
Do you do any incentives to close?
Not-
Is it monthly promotions? What?
It's hard because once you spend all that time and effort, if you're going to walk away from a transaction that you're like 90% there and you're going to walk away for the 10%, that's hard to do.
When you're pushing, and you come off as a.
And so that's why I said I give aspirational deadlines. If you think you're realistically going to close next March, you should say, let's try to close January. Because if you say March, it's not going to be March. It's going to be June. But what I do a dose of reality was when we do the valuation and we do the sensitivity analysis, you've got to build into the fact that it could be earlier or it could be later. And then that's when the management team and the executive team gets in. But to close 50, 60 deals, that's hard to do. That's really hard to do. But I would say aspirational deadlines and keep adjusting them, but keep the pressure on because things happen. Turning paper, turning documents take a lot of time, particularly if you're in a comprehensive business. But I do think that's the way to do it. It's constant pressure.
And it sounds like getting aligned too. Like you mentioned, just if you have the aspirational deadline, not a hard deadline, don't put too much pressure.
Because I find in most instances, and look, unless you're a PE firm, which it's easy because that's all you're doing for the most part. I mean, I know you're on boards and the like, but your job, probably 80 to 90% of it is you're actually executing transactions, looking for transactions. But when you go to a strategic or corporate that's actually making acquisitions, a lot of your team has day jobs. So it's really hard. It's really hard to get everybody exclusively involved. And they do get involved at times, but that's when you're almost there and you can see the end line.
All right, our next question is from Desi. How do you manage resistance to change in order to increase retention and realization of synergies?
The resistance to change? Yeah, so it is a big thing. Historically, and we get this even in the non-M&A side, everybody wants to just say, well, this is how we've done it. You got to really fight that. You've got to constantly be looking at things in a different way and trying to figure out a more efficient solution going forward, particularly on synergies. Absolutely. Everybody wants them to happen sooner rather than later. And that's where it's critical on the integration side to get the right people involved and say, hey, look, we've got to land, 20% more new clients on this new book of business. How do we do it? Have you scanned the market? Have you gone through it? So those are the things that you got to get down to in terms of looking at the opportunity and then maybe even setting milestones, maybe on a sub-level by synergy so that people know that they're getting there. And change, they're getting sold, so they better be open to change. It's a new company, it's a new place. But I think in most instances, we sell our employees on that this is what you do. This is what we do. You're part of a large banking organization, or you're part of a large asset management or wealth organization, but this is what we do. We're core. It's core. So when you come to us, you're going to be core. You're not going to be one of many. You're just going to be one of a few, which I think is a big thing. And that adds a bit of cultural change and people who do want to change and be part of something that's moving, I think, at a much more concentrated pace.
How do you approach estimating carve-out costs?
Again, it's bespoke to the actual transaction that you're looking at. And then I would say, going back to the non-binding letter, that letter of intent, however you want to call it, the bid, you have to have assumptions in there as to what you think the ongoing costs are. And that's third party, operations, compensation, and the like. I would say there are other, extra, costs that are outside of that zone. And those costs are your deal fees, your legal fees, your transition costs, starting stuff, creating stuff, travel. So you should have a general range based on past transactions. So you should be able to just take an estimate and start to map it out. For large publicly traded organizations, it's not a great thing, and it's becoming scrutinized more and more, I think, by investors and shareholders is, they exclude deal fees or one-time fees out of transactions. You have that liberty, but it's a double-edged sword. You got to be careful. It's not something you can use all the time. But in reality, when shareholders and investors are looking at your growth rate and your return, and they know that those deal costs or those deal fees aren't going to happen in the next 2 to 5 years because they only happen when you close the transaction, those should legitimately be taken out of the run rate. So those costs can fit in that bucket, but you got to be careful and you got to adhere to what the requirements are under the accounting rules. But I think those are the areas that you focus on. It's really hard, and you got to know what the migration is. How do you get clients on board? What's it take to repaper clients? And the other critical aspect is when we go in, one of the first things that I think our legal team looks at is are the contracts, do they have a change of control provision, right? So if it's a share deal, in a lot of cases, you don't need to go and get consent from each client, which is great. Reduces your legal costs, your tracking costs. So it does vary by transaction, and you should be able to estimate it based on your past deals. But again, it's got to be a range. It's
Great.
very difficult.
I want to break this down because this is an interesting one that is pretty critical. So if it's a share deal, you're taking over entity purchasing the shares. Which
in most instances, there are jurisdictions and requirements where you still need to get it, but I would say for the most part, yes.
And then your agreements stay intact because there technically isn't a change of control. Or there isn't a change of control in the sense that you are you're going to have them sign a new contract, basically.
Yeah, and some of them you don't have to sign a new contract, and that's another thing that's critical we didn't talk about as well is understanding the client composition. Because if it's very concentrated, then what you want to do is focus on, it's the 80-20 rule, right? You want to focus on the large clients that are providing most of your revenue, and then you have the small tail of clients. But what we find in our industry, and probably happens in most others, is clients don't usually walk. They wait around to see. And then you need to look at the repricing ability of the clients in the contracts as well, because a lot of them, they don't have the ability to reprice. And fortunately for some of our businesses, to move off of the platform that we're acquiring, it's disruptive for the client. And so that's a retention component as well. You want it all to go smoothly. So that's where we're at. And you just need to make sure that you're thinking about the retention, what the legal requirements are, and what the work that needs to be done. I did a transaction just recently where we tried to sell a business within our company, and we got all the way to the end, and the clients didn't want to. It was a small business, but the client didn't want to do the conversion of the contracts. They had to go get positive consent from every single client, and we do that all the time. So I was surprised by, well, we're not interested. We don't want to do that transition.
That's what I was curious about this stuff, because I feel like it happens post LOI. Then you find out all these contracts have change of control provision, and then it becomes a lot messier to work through.
Yeah, and to me, I chalk that up to them not having a formalized expert deal team, because everything went sequentially.
Right.
And that's not having somebody on the integration side or on the legal side that says, how are we going to get these clients on board? They didn't think about that until the end. Yep. And we were just assuming that they understood that all the way through.
So surprises you don't want. What are, can we recap, what are the major deal breakers that would cause you to walk away from a carve-out during the process? Yeah,
I think it's uncertainty on the perimeter is the first one. And the second one, I would say, employees in scope. You absolutely need to know who's going to be there day one, so you can perform the services that are required day one. You can't slip up or be deficient on that.
How do you differentiate that between when you say uncertainty on perimeters?
Well, so uncertainty on perimeter in terms of services. So I'm not thinking individuals, right? So this could go to, I'm getting a feed from this area, I'm getting a feed from that area.
Okay.
It doesn't involve an employee, but it's critical information that's needed to perform the service.
So this is the broader business versus the actual operational, the employees in scope.
That's correct.
So know what you're buying at the end of the day. Yes. If you can't define what you're buying.
Right. And you can't perform the service because you forgot about it and we didn't we didn't transition it over or build an interface to ensure that was showing up.
That sounds like the hardest part of doing these carve-outs.
It is, and that's why our team needs to be augmented with the right people who really know their stuff and really know how the process works.
Where does the future look like? Are you going to see more carve-outs in the future? Less?
Yeah, I mean, I think we're always looking, inward out, and we've been focused on growing the business and actually trying to do this the right way, and we help out even on the organic side internally with the investment side when things aren't happening from an M&A perspective. Or we're terribly swamped in the pipeline, but it is a concerted effort. We wear different hats, and we try to think creatively. Look, I mean, an acquisition's hard to do, and I said it earlier. It's not part of our strategy. It's to help our strategy, and if we think we can get there quicker, it's something that we're interested in. But we're not out there just to acquire for the sake of acquiring at all. I mean, we're fairly global, established. Quality provider to our clients globally. And so I think we're focused on keeping shareholders happy, but also making sure that we're building a long-term approach.
Optimistic. Hard to do, but still optimistic that more to come. I got to ask, what's the craziest thing you've seen in M&A?
Yeah, I have a couple, but I'll stick to one because we're down to the time. When I talked earlier about having that asset manager who's a captive, who's going to become a major client, you need to commercialize the arrangement with them. We were down to the wire on a certain transaction outside of the U.S., and the head of the asset manager caught pneumonia. And I didn't know this until my deal counterpart called me and said, we need to have a meeting. And I showed up with the head of Europe and myself. And we said, okay, it was a meeting. We show up to a different building, and we walk into the building. And when we walk in, there's this big video screen. And he said, sit down. So we sat down, and then the screen lit up, and a gentleman with an IV in his arm and a hospital smock walks in and sits down in a chair and proceeds to tell us that he's not going to agree to the price that we agreed on in the underlying valuation. So he's in the hospital telling us, and then to top it off, this was probably 15 years ago. There was a delay in this. Remember when we used to have delays? There was a delay, so we would speak, and he would start speaking before we would finish, and it just went back and forth. It was crazy. But nevertheless, we got the message. And then, triage through the night, all night negotiations to try to figure it out, because the parent company's saying, we want to get the deal done. Yet this gentleman's in the hospital. We got to figure it out. We were down to the wire. We ultimately got there, but that was a pretty crazy story. Sitting at dinner the next day with my colleague saying, that was strange.
Negotiating from the ER.
That's right.
Keith, this has been a great conversation. I appreciate you taking the time from doing deals.
Thanks for having me.
Helping me become a better M&A scientist. Those of you that have been tuning in live, hey, as usual, I'd love to hear from you. Love the feedback and hear from you. So feel free to reach out to me on LinkedIn, like topic ideas. So I appreciate you joining us. Stay tuned for the next session after this 15-minute break.